We're joined today by Ann Sonders, the Chief Investment Strategist at Charles Schwab and Company, and we're going to talk about bubbles. Bubbles have been in the news for really a decade, starting with tech, then real estate. There was talk of a bond bubble, unclear whether we're in one or not, might be letting the air out slowly. What do you see as the current bubble?
Well, I would agree that I think bubble is probably not the right term to use for bonds. I think there was excess investment in bonds as investors fled toward safety. And I do think the air is coming out of that, but I don't know that it's necessarily a bubble, because if you buy a bond and you hold it to maturity, you get the return. So it's a little bit different. You know, commodities certainly have some bubble-like characteristics at this point. You know, the tough thing is bubbles are hard to pinpoint precisely at the time. We all blatantly know them in hindsight. But there's certainly some froth in commodities that I think investors at least ought to be mindful of, particularly those that are investing in commodities.
I'm going to tread on dangerous territory here. Whenever we even hint that gold might not be the perfect investment, we get ravaged by a certain segment of readers. But let's go there. Certainly gold is a commodity. It tends to be a place where scared investors go. What do you think of the gold market right now?
You know, there's a lot I can say about gold. I think there's nothing wrong with gold as a portion of an investor's portfolio. My concern is that it's becoming a larger and larger portion because it's an asset class that's done well, and individual investors in particular have proven to be very adept at chasing performance. Gold in the past has been very much an inflation hedge, but that's really not what it's been trading on these days. It's been more of a currency hedge, kind of a fear-based trade. But also the important thing is there's a lot more vehicles now through which investors can access gold. It's no longer that you actually have to go out and buy the bullion, buy the bars. There are exchange-traded funds. There's other investment vehicles that, like this, an investor can get exposure. So I think it's represented an amount of demand, arguably some speculative demand, that has the potential to make the moves a little bit more extreme. I'm not here to say it's a bubble and we're at a top, but I'd be very mindful if you're an investor in gold. Figure out what makes sense as a core position and make sure you're kind of paring that back with any kind of excess gains, because there is a lot of speculation. And I would say right now, it's what we sometimes call in the business as a one-sided trade. No sellers. All buyers, no sellers. And that's always something you have to be wary of.
So speaking of buyers and sellers, you had an interesting statistic in your most recent report, which was that 90% of all Treasury bond purchases, U.S. Treasury bonds, since November, had been by the Federal Reserve as part of their QE2 program. Another 8% was by foreign governments. So that only leaves 2% by the private market. Now, does that mean once QE2 stops and the Fed stops buying, there will be no private market for U.S. debt?
Oh, not necessarily. I think we have to distinguish between the Fed as a buyer and the Fed as a seller. QE2 comes to an end ostensibly in June, and I think it does. I don't think they extend it. I don't think they announce QE3. But that doesn't mean the Fed turns around and becomes a seller of those same treasuries. In fact, I think they keep them on their balance sheet and basically let them work off from a maturity perspective. So that means that there's still $600 billion of U.S. Treasuries out of supply, and that has displaced money into other things by investors, whether it's individual investors or foreign central banks. And that money, I think, stays relatively displaced. Now, for reasons including the Fed being absent as a strong buyer, but also because I have a fairly optimistic outlook on the economy, I think yields are heading up. And that one of the impacts on that will be the fact that the Fed is absent as a buyer. So remember, bond prices and yields move in the opposite direction. So I think the path of least resistance is up for yields, but we have a fairly benign outlook. We don't view QE2 coming to an end at the moment it ends as going to be some, first of all, it's been known.
It's not a surprise.
It's not a surprise. And most big reactions by markets, bond market, stock market, come because there's something that comes out of left field. If you're not aware that QE2 is ending in June, you haven't been paying attention.
Sure. So there's a lot of interesting parts here: commodities, bonds, interest rates possibly rising. How does this all play into inflation? Are you worried about inflation?
Well, you know, it depends on how you define inflation. There's lots of varieties of inflation. If we're talking about commodity inflation, we have it in spades right now. it has an economic impact. It acts as a regressive tax on the economy because it does hit low-income people more than it hits high-income people, and it hits an economy that's more energy dependent and all of those things. So to say we don't have an inflation problem, a lot of people mean we may not have a generalized inflation problem outside of commodities. Even those people are not suggesting that ever-rising commodity prices is good for the economy. It's just a question of whether it's going to become more generalized inflation. And I just don't think the risk of that is very high right now. Wages are low. There's a lot of excess global capacity. So the conditions are not in place for companies to be able to pass along those higher input costs all the way through the pipeline to the end user. So what's going to take the hit in that process will be wages, unfortunately. So I don't think we have a generalized inflation problem, which means the Fed is not going to have to step in and aggressively start to try to combat this problem. We've got a commodity inflation problem that brings with it other problems. Just don't think it's going to turn into generalized inflation, not in the near term.
Great. Well, thank you so much, Liz.
Thanks for having me.
And thank you for watching.